more questions. Having that sorted, let me get into the webinar. So this, as you know, when you signed up for, this is about the cost and finance section in CPSM 1. Bear in mind, there are a lot more, if you were to look at it as a true webinar in cost and finance, there are a lot more criteria and categories that would have been part of this. But since we're doing a CPSM review, I'm constrained by what is in the study material, and for the most part, I've tried to stick to the study material. So what we will be doing is, let me give you a quick heads up on what this is. So as you know, the CPSM has multiple questions, and especially the cost and finance chapter, if I can call it that, has about 32 questions overall in the CPSM. So agenda-wise, I will stick to the flow in the CPSM book. I'll first start with an introduction about myself, for those of you that don't know me. But I do see a lot of familiar faces, so I might just skip through the introduction. And then we'll talk about budgeting, which has about 5 questions in the actual CPSM exam, cost management strategies, spend analysis, different types of cost and benefit analysis, and finally we will top it off with financing and leveraging strategies. So let's, here's a little bit about myself. I am one of the directors at ISM-INDIA. I am based out of Chennai, India, where I also run a procurement advisory company called BQ Global Solutions. We assist different companies with their procurement and supply management needs. I have an MBA from Purdue University in the US, and I've moved back a few years ago to India in Chennai, where I'm originally from, to start my organization. I'm also CPSM certified, although I completed it about 6 years ago, if not more. I think 2010 is what it was. So I might be a bit rusty in some of the topics that I'm talking about, but still, hey, this is just a review session. So, and I often engage in a lot of training with ISM, as well as public speaking in conferences and workshops related to procurement. So let's jump along into budgeting. You know, as we all know, a budget is a critical part of an organization's cost management plan. Each organization, as you all know, will have a plan to mitigate costs, and a budget is one of the critical portions of it. So what we will try to do in the coming, in the next few slides, is tie the budget to link it to the strategy and operational goals. We'll review the various steps in budgeting, and then understand why we really need a budget, and finish it off with the various types of budgets that are typically used. So in terms of relationship to strategic and operational goals of an organization, usually a budget is done when you plan for a series of actions, and you try to identify the associated funding levels in order to complete them successfully. And as you all know, these are developed in terms of cost, and how they link to strategic and operational goals is that one, in the goal setting aspect of it, budgets provide input to the goal setting, because you always tie a list of specific goals with respect to your future operations and tie them to the budget. So that is one area where it helps with the strategic initiatives, because based on how you achieve your goals in the future, a budget may be modified accordingly in terms of cash flow and money released to finance those projects. And the other aspect to which it ties into your operational performance is budgets mean that you have to have a periodic review of how you track with respect to your goals, and you compare the actual results versus the established or the planned results, and that way having a good budgeting plan ties into your operational performance as well. So now that we understand how budgets work, and let's try to understand the various steps in budgeting. One is, number one, you start with the alignment. So typically an organization's strategic goals have to be aligned to a budget. It then requires a little bit of foresight and planning, where you try to estimate the required resources in terms of personnel, equipment, training needs, etc. And once you've identified the resources required, you then try to put a dollar value or a value to the resources. And one area that can help or assist in estimating this value is using the previous year's cost and kind of trying to see how it has changed this year with respect to last year. So one concept worth mentioning is standard costs, which you might be aware of. And once then that you have estimated the value to the resources and identified these are the requirements, then you obtain appropriation, or the other word is approval for these money to be linked in. And this process it's not standard, it's unique. How approvals are done are unique to different organizations. So once the approval is granted, then you perform, and assuming the budget is actually operational, you do a variance analysis where, like I talked about in the previous slide, you track expenditure and identify variance with respect to the planned goals or preset objectives. And then once you understand the variance, you try to practically understand why they exist, and then you make the corrections. So this process is a repeatable process, and that would, the variance analysis is more of an ongoing process that you need to do. And once that is done, I think we've sort of in the completion of a budget process. So this is fairly a simple one. Why do we have budgets? I think, as you know, is predominantly the biggest byproduct of a budget is it provides a means for controlling your expenditures relative to business activity. So you don't want to be spending, for example, when the external market is slow, you don't want to be spending heavily on purchases or travel or any other expense that are variable. So budgets provide a mean to do that. They tie the output or the sometimes often they tie your release of money to the actual output. So as a result, they help in control of expenditures. And this has been, I've talked about this twice already. It helps with the monitoring in terms of providing feedback on planned versus actual. And the other area where budgets serve well is they are a tool of pre-approved funding. So you don't have to, when execution is critical, you don't have to go and wait through an approval process. A preset budget indicates that you already have the blessings of the senior management, and execution then becomes easy. Another byproduct, as I mentioned, is the standard cost setting. Is it kind of gives you an idea of your performance as a procurement professional, because standard costs are what were incurred typically as in the previous year, and then you match your current cost performance to standard costs to identify cost savings and whatnot. So there are, plenty of types of budgets. I'm just going to talk about 7 commonly used budget terms, and there are straight away there is, it's important you understand or have a, you don't have to have in-depth understanding of all these concepts, because though finance is critical, from my experience, the CPSM tests your knowledge about, it's more of a well-rounded degree, especially with relation to finance. So when it comes to procurement and supply topics, often I've noticed that the CPSM typically goes in depth, but finance, Incoterms, and a few other things, it's the questions that I have encountered, if I recall correctly, were more of a, how do I put it, of more of a definition slash tests your knowledge about these things, not in depth. So that being said, I'll just talk you through the 7 different types of budgets. So they are zero-based, cash flow, line item, project or a program budget, capital budgets, flexible and headcount-based budgets as well. A zero-based budget is typically where you start from scratch. You don't use any previous experience in defining a budget and so on. It sort of very rarely, when organizations want to make a fresh start, or they try to use this type of budgeting, it is almost, it goes against all the traditional modes of approaching a budget. A cash flow based budgets is what I think I alluded to previously, is when the budgeted expenditures are linked to revenue. So this help in controlling your costs, especially in a tough global environment. I think a cash flow based budget would work well. A line item based budget is more of an in-depth budget, where each expenses are incrementally assigned a particular value. A program or a project based budget is used typically by a non-profit or NGOs. They use productivity measurements and link cash release to productivity. Capital budgets are plans for investing in either equipment that's expensive or for acquiring assets that are more long-term in nature. Sometimes it is used in short-term asset purchase as well, and if the cost is significant. Flexible or variable budgets, as you know, as the name suggests, is a type of budget which is more suitable for changing market conditions, where there is a lot of flux in terms of the external market, and this is often has a lot of parameters that tie it to economic activity, and is flexible, as the name suggests, as the economy changes. And headcount-based budget is typically calculated based on the number of full-time employees that you have, and what it tries to do is it tries to ascertain a value or to a per head basis. So that is why it is called a headcount. And there are these and a lot more, but for the purpose of this review, we will stick to that, just these 7 commonly used types of budgets. And one more quick suggestion, predominantly from a test taking or an exam point of view, is you will understand that there are certain chapters within the CPSM that are that have very little in terms of actual content, and this is one such example. If you consider budgets versus, some of the topics that you will encounter in the future, the budget chapter provides greater bang for your buck in that it has a limited set of information that you need to glean, but it also has, I think, if I remember right from the beginning slide, it has about 5 questions. So these are some of the chapters that you should look at maximizing in terms of purely looking at it from an exam perspective, as a test-taking perspective. There are some chapters that are 30, 40 pages long, but they have 6 questions, while on the other hand you have 6-page chapters that have 6 questions. So you know where you want to focus your energies on. This is one such chapter. So with this various types of budgets, we come to the end of this chapter, and we'll move on to the next one, which is cost management strategies. And cost management strategies is, I think, is something that in a day-to-day role, this is also fairly practical. I think the knowledge that you gain from this area is you would have encountered all the topics that I'm going to talk about. So I'll breeze through this. If you have any questions, so feel free to always reach out to me. So in terms of knowledge, we've acquired this as procurement professionals over a period of time. Maybe there are some issues that are raised that we need to be aware of, and we'll also discuss a few concepts involved or strategies in cost management. First up, this is something that we are sick and tired of hearing, cost savings, because this is what our bosses want, this is what our bosses' want. So cost reduction, cost savings is the death of a procurement profession. It's always about cost saving. But it's important to understand under cost savings that there are 2 areas. One is cost avoidance and the other is cost reduction. Cost avoidance is typically, in an inflationary environment where, for example, if the prices of commodities are increasing at an alarming rate, and your suppliers are forced to pass along those commodity price increases to you, and where you're able to negotiate a lower rate even though the external market conditions make it hard to do so. That is a predominantly a perfect example of cost avoidance, where you actually prevent a perfectly understandable increase in price, and you negotiate it down. And most organizations have different policies on how you approach cost avoidance. So you have to make that very clear in terms of cost savings, that there is a distinction that exists: cost avoidance and cost reduction. They have to be reported separately, ideally. So cost reduction is something that can directly lower the cost. So it has a direct impact on the cash flow, where the cost of what you purchase compared to the previous purchase price is lower. And so these are more easier to understand and report, while cost avoidance is particularly a bit more complex. So, but pay heed to this and understand the difference. So, as you're trying to establish a cost management program, there are a bunch of issues that you need to consider. One is standardization, because oftentimes when you have standards, you perfectly well know that provides repeatability, and as a result, you're able to reduce variations and thereby reduce costs. Another area which is also critical is you coordinate with other departments as you're developing your cost management program, because you understand the requirements of your internal stakeholders. Try to incorporate them, because when it comes to execution, you know that you have their buy-in already if you were if they were involved with the program definition. Same way that you try to seek your internal stakeholders' requirements, you also should go to the external market and seek out the supplier's perspective, because that will give you, help you understand the processes at the suppliers and the constraints and their perspective of things. One other area is time requirement. You don't want to be spending a lot of time on a particular program that yields very little results. So estimation of the time required for a program should be considered. And it should be noted that a new cost management program or a new strategic sourcing initiative that you do should not compromise on quality or service, and you should have appropriate guidelines to ensure that quality and level of service is in no way compromised. And it can also sometimes have a positive impact on operations, because it can help streamline your operations and make them more efficient. As I mentioned in the previous slide, you also have to have a preset way or a methodology on how you're going to calculate cost savings, so because you don't run into complications later as the program is in effect. Once you have arrived at a sort of a cost management strategy / initiative / program, before you actually do implement it, I think you might consider testing it first, inviting some feedback, and then based on the results, make appropriate changes and then implement. Top support is critical. You don't want to do something that isn't championed by senior management, because later you don't want to do something, and when you're ready to deliver savings, you don't want your senior management to come and say, hey, this is becoming too expensive. I don't know why you started this in the first place. So another area to consider is actual design, right? This design flexibility, having such flexibility, and this involves coordinating with the engineering department, is that try to establish design that have multiple applications. So as a result, you can easily adapt a particular design to others. Product longevity should be part of the cost management strategy. Consider the useful life of a product and how it impacts purchasing. You don't want to compare a product that has a 1-year expiry with something that has a 5-year expiry period. Even if you do, try to be cognizant of the total value or the life cycle of the product. Another area while you should also look at is, while you're purchasing resources or goods or services, also try to understand the consumption, or the typically when I say consumption, it usually is energy requirements. For example, if you're purchasing bulbs, an LED bulb will, almost simple to consider, but this is something that an LED bulb will consume lower energy than a regular filament bulb. Okay, so something like that is you should stay cognizant of it. So moving on, we're going to talk about the value analysis, value engineering process, and this is, most organizations have instituted a formal VA/VE process, and it can be defined as the systematic and objective evaluation of the value of a good or a service. And the goal, as is stated, is that the goal of a VA/VE program / process is to achieve the lowest cost without loss of performance, quality, or reliability. And typically a VA/VE process is, done in conjunction with your various suppliers. So the process, the actual process is when you actually evaluate all aspects of design and function of a particular product or a service. So once you start questioning why this, for example, in a particular take in case of manufacturing environment, you have VAVE look at the design and say, why is this part of the design vital to the overall product? And once you start each sub design, you will be able to identify the value of it, and then and that's how you proceed. So this is typically done as an initiative with your internal engineering teams and suppliers engineering team. So they're able to provide inputs, and you get a 360-degree perspective of the product or a service. And there are, a lot of techniques that help you ascertain. So I think I alluded to this earlier. Is how do we simplify the design? How do we eliminate even some of the parts where can we eliminate the part and still have the final assembly perform its function as desired? These are some of the questions that you sort of ask through the VAV process. So as you begin questioning everything, you try to understand why they are in place, and you also try to get to the best value for money, which, as most of my audience is from India, this is something that we don't have to be given any additional advice on. We're all about value for money. So, and in terms of, as you're going through the VAV process, in terms of organization, I think it's best if supply management leads this initiative, although I mentioned that there are other departments involved. But I think in terms of coordination, if we have supply management leading this initiative, I think this works best. And ultimately, you try to arrive at function in relation to cost and quality. And so what you try to do through the VAV process is try to obtain the maximum functional value of a product. And that is ultimately the end goal of the VAV process. So because this, if you arrive at the maximum functional value of a product, you automatically increase the overall value that it offers to your department and ultimately the organization. So the VAV process is a typically commonly used process for cost management. I have seen in my company, we typically do this once or twice a year. There is a bit of cost involved, but the benefits outweigh the cost. So if you're not doing a VAV process, maybe it's time you try to consider one. So as we're looking through, there are a lot of elements to consider as you're looking at cost management. I think one that I talked about is modeling your costs. So cost modeling is typically done when you want to understand your supplier pricing strategy. So you try to break down the total cost of a good or a service into material, labor, and overhead. And sometimes you use regression techniques or scatter plots to model supplier's pricing strategy. And one similar one is the standard cost setting, where we talk about this is it's a predetermined or a planned cost of manufacturing a single or a certain number of units during a specific period. In the organization that I worked in the US, we had a methodology to set the standard cost as the last. So the US works in a calendar year financial year. So For us, the last price paid in November, not even December, was considered the standard cost for the forthcoming year. And each organization will have a different means to set standard cost, but so this is an important element to understand. And we should also, as supply management professionals, we would have learned by now in practice that there is a cost of quality. In fact, more than quality, it should read cost of poor quality, because that's what has come back to bite us most times. Typically, I think based on research done by ISM, the cost of quality is about 30 to 40% of the total cost of the product, And when you look at the cost of poor quality, you should look, there are four major types. There are, prevention costs that are, for example, you try to prevent poor quality product or a service. So you supplier certification, you certify suppliers, there is a cost associated with that. Appraisal is where you do inspection and testing. Internal failure costs are those that you have a poor product that has been supplied to you, and you either scrap it or you rework it. And then also in terms of external failure costs, this is when actually that the product is out in the market and it has failed, and then you have warranty costs associated with it. So most of this, as you can see, are all related to a manufacturing setting, because this was, I think this the CPSM was written maybe I would say close to 10-15 years ago in terms of the coursework. Maybe I might be wrong on that, but it has been constantly reworked. But again, most of these are applicable to a manufacturing setting. But if you're not from a manufacturing industry per se, try to see how closely this impacts your organization and the industry in which you operate in. One other area is the total cost of ownership, where you try to put a numerical value to the cost incurred over the lifetime of a product. So there are two ways of approaching this. You either look at pre-transaction, the actual transaction, and post-transaction costs, or you also look at it as total cost of acquisition if you're outsourcing it, and the cost of producing it in-house. So that is another approach as well. There are a lot more of cost elements as well. And most of these are pretty simple. Let me just check to see how we're doing on time. Oops, I think we'll have to go much faster. So product cost roll-up is where you independently assign a cost or a value to various cost centers and roll them up. Margins is where it's self-explanatory, where you understand the ratio of operating profit to volume. Contribution to profit, or the contribution margin, is the sales revenue minus variable costs. And the inventory holding costs are also part of the analysis. Holding or carrying costs is what they're called. Some examples are opportunity costs, which we will talk about later, storage cost, handling costs, taxes, insurance, and whatnot. Intangible costs are those that are not really apparent, but if you do some digging, you will get to them. For example, loss of a particular customer, you can attribute a particular numerical value to it, and those are intangible costs. Loss of business image is also one, and a few others that have improved form, fit, and function, easier use, cost attributed to improved quality, and administrative savings, which you can look at. Moving on. Okay, I think we're now, I would say we're about 40% through. The 3, 4, and 5. We have 3 more chapters, so let me rush through this. And spend analysis is something that even I have talked about. I've done full webinars on spend analysis, so I'll pretty much rush through this. They're typically used to identify savings opportunities, and you do them by analysis of your historical spending. And how you do that is you classify your data into various categories and create strategies for each. So what are some of the sources of spend data? So on the left, we will consider sources where typically they are your accounts payable. They account 85 to 90% of the source of your spend data. Wherein AP data is not sufficient, you kind of look to suppliers' data and have that contribute. Some of the other examples are, you look at general ledger items, P cards if you use them, and whatnot. And another source is market intelligence, which they provide an insight on how external forces influence your categories of the commodities in which you purchase. Benchmarking is also a source of spend data. It provides you an opportunity to compare your performance to world-class organizations. And in terms of tools, there are, I think we've come a long way in this area, particularly in terms of spend analysis tools. There are now multiple tools that perform great things that assist a procurement and supply professional with respect to mining data and generating a lot of insight. And typically what is a successful outcome of a spend analysis exercise is A, classification, and B, the actual analysis, and then C, cost savings through standardization, leverage, and negotiation. So we talked about setting cost baselines, how cost baseline is actually an important aspect of spend analysis, because they provide basis on which your spend analysis efforts are built upon. So you forecasting, how are they set? You try to use both qualitative techniques and economic data to try to forecast your costs out into the future. And cost savings versus cost avoidance is something that I already talked about. Oftentimes you have to understand that cost savings initiatives lead to results in which it can reduce the budget. So as you generate more cost savings, which means that your budgets need to be accordingly incorporated or changed to account for the lower cost. And like I mentioned, this is fairly a simple point. It provides the baseline for future cost comparison. So oftentimes, bear with me, because there are certain topics that are repeated. There are certain topics that are very, very simple, but I still have a placeholder for them here, because in the study material that we have, it is listed this way. So I want to stick to the study material, even though in certain cases it becomes pretty hard, because the more practical way is different. But still, I've stuck to the study material where necessary. And so this is another area where you in spend analysis, this is in fact a very, very huge area, but segmentation or categorization of your spending is you try to group them into buckets that are very, very similar in nature. And one concept, this is something interesting, maybe this is something worth doing as well in your spend, is you try to, in addition to various categories, you also try to segment within a particular category as what is addressable spend and what is non-addressable spend. So for example, addressable spend is something that is you can have strategic sourcing initiatives or cost savings initiatives on, while there are certain portions of your spend that you find it incredibly hard to do a sourcing event on. For example, these are sometimes not in your control at all. For example, taxes and license fees, and also in certain cases where you have a very close relationship with the supplier and it's a joint engineering effort and you're almost tied at the hip to a particular supplier, that is almost considered non-addressable spend. In fact, categorization is also done by various cost centers, which is quite easy to understand, and also by the various categories / commodities, sometimes even the geography. So that is something to keep in mind. With that, I think we complete the third chapter. So we move on to the fourth one, which is cost benefit analysis. So this contains a lot of various types of cost benefit analysis that are performed. It's important that you have a cursory knowledge of all this. And the critical one, which I think a lot of time has been spent on, is the leasing aspect of it. And you have to understand that a lot of it is also written with a view to the US environment, and you have to stay cognizant of this as you're preparing or undertaking questions in your CPSM test. So it is pretty apparent that as supply management professionals, we have to have a keen knowledge about various cost and financial terms. The more you know, the more you grow. Is something that I just thought of. But yeah, that is pretty apparent, I think, in this environment. So total cost of ownership is something that all of us know. What is the total cost? What are the various approaches for supply management professionals to arrive at total cost of ownership? One is the unit total cost approach, where you almost roll up. This is something that you do. For example, in a manufacturing setting, you roll up all the cost of a particular unit in the bill of material. So you roll up the entire bill of material to arrive at one cost, and you kind of add associated costs over the lifetime, then try to match one versus the other. That is one such approach. The life cycle cost is where you look at the purchase price and also include the related costs that are, maintenance, downtime, and even salvage value. Salvage value is the value that you get when you sell a particular resource or a unit that has no value to you, but still has some value when you sell it. So scrap is one such example. So whatever you buy, if the non-value adding item, you can sell it and still have a salvage at the end of it. Landed costs is usually done, this type of analysis or the approach to total cost of ownership is done for products that are imported. So you break down all the various costs that are associated with importing a particular good. That includes, freight, handling, duties, customs, warehousing, storage, and logistics costs as well. And in case you're purchasing services, you have to understand the total cost of performance. For example, you buy a particular product from an OEM or a supplier, but you oftentimes find that the maintenance, you get better value if you were to outsource the maintenance and not go with the person that you purchased this product or service from. So that is something that you can consider. So this is another area which is, I'll quickly screen through this. We all know what direct and indirect costs are. Directs are those that are directly linked to individual units of output that a company manufactures or it outputs. Direct typically accounts for a huge proportion of total costs, and they help in forming the basis for calculating overheads, while indirect are not directly identified with specific products but are related to the operations. There are indirect costs are further split into three categories: fixed, variable, and semi-variable. Examples are, fixed cost is a mortgage, which remains constant. Material costs, which change, is flexible with related to the amount procured. And there are semi-variable costs which contain both fixed and variable components like salaries. So this is a simple concept, really, one I think that all of you will be aware of. So direct and indirect costs. And some of the more analysis frameworks, I think most companies already do this. So understand or try to model your carrying costs, your should cost and target cost are something very similar, where should cost is you objectively try to estimate what the product or service should cost, and then you use that as a tool during negotiation. While in target cost, you almost set a preset value for target, and then work with the supplier to achieve that target cost. Opportunity costs is something where you choose one option over the other, and sometimes you know that you're giving up something of value by choosing one over the other. For example, if a simple example, as crude as it may, it's a very simplified example, is if you're choosing a product, let's say, that generates $5 savings versus another that has a $3 savings. Okay, is everybody able to hear me correctly, clearly? I just got a note that my audio connection was out. Just shoot a quick note to say if I can carry on, please. All right, thank you. Thanks for that, Naeem. And you also should consider, excuse me, overhead costs, which you all know what it is. So activity-based costing, or ABC approach, is also something that you should be aware of, where it uses multiple indirect pools to achieve and then rolls up as one cost. And there are a bunch of more financial analysis measures that you should be aware of. These are fairly simple. Return on investment, net present value, which compares the value today versus the same, compares $1 value today versus $1 value out sometime in the future. Internal rate of return, which is something in each organization has. Return on assets employed, return on total assets, margin analysis, profitability, cash flow, balance sheet. You should all be aware of how to read balance sheets, profit and loss statements, understand the concept of time value of money, which is essentially the value of money over a period of time. Like when you use NPV, you compare dollar value today versus dollar value out in the future. That is, you get to the time value of money. Working capital is another concept that is quite similar. So a lot of these have calculations, and it is wise for you to just go through the formulas for calculating each of this, because I think, if I remember right, pardon me if I may be wrong, but this was, I think I had a few questions in my CPSM that had, hey, calculate the margin on this, calculate the return on investment on this, and so on. So keep that in mind. And then we get into leasing, which is a concept which is, I think most of you are involved or would have been involved in leasing agreements. There are, 4 major types of leases typically, plus 2 other which are specific to a few industries. So an operating lease is used when you use capital intensive equipments for a short period. So example, always I think as you try to understand these various types of lease, try to look at it from the example point of view and then understand it. It becomes much more easier than going the other way around, where you try to understand the concept and then apply the example to it. So automobile rental is a great example of an operating lease. So that's fairly self-explanatory. Financial lease is something also that you should remember. It has 3 types or 3 subcategories. Full payout, which is at the end of it, it refers to the payout at the end of the lifetime. So full payout, partial payout, and a lease/purchase are the 3 categories. There is, excuse me, I clicked the wrong button. A leverage lease is where you have a third party that buys the asset and then leases it to another organization. And this is something that I think my company did as well. We made earth moving equipment. So those are, typically really expensive to purchase. So as a result, the way we worked through it was we had a lot of people that leased these trucks and cranes from us, and then they would rent it out to other organizations. So there are a few tax benefits as well to this approach. And there is also a concept known as master lease, which you try to negotiate with a particular vendor for a wide range of items, and it becomes easy for you. For example, if you're leasing out trucks from a particular vendor, the master lease can also include all types of automobiles. So this can be extended to bicycles or cars or motorcycles or whatnot. So that is just a crude example of that. There are also 2 more types of leases that you should be aware of. The wet/dry lease, which is specific to the aircraft industry, where a dry lease is only provides financing, while a wet lease also includes operational costs like fuel and maintenance. A sale and lease back is where you sell the asset to a second party who then leases it back. So these are some types of leases. There are multiple factors that you need to consider while making a lease versus purchase decision. This is, most of these categories you understand. I don't have to go into defining. So there are 3 major factors that you should consider: financial factors, operational factors, and a bunch of stuff that has been lumped into what they call other factors. Financial factors are, inflation, budgets, interest rates, cash flow, depreciation. All these need to factor into your lease versus buy decision, which all of us would have made in the past or would be making now in our day-to-day function. Operational factors include cost of obsolescence, maintenance, overhead, etc. There are a whole bunch of other factors like ownership benefits, early termination, insurance, emergency costs that can rise, and so on. So all these, while making a lease versus buy decision, make sure you consider all these factors. And this is an area that is particularly relevant to US organizations. So I think you do try to spend some time if your client is in the US or if your organization has a lot of operations in the US, try to understand this. I'm not going to go into a great detail through this, but the UCC2, which is I think the Uniform Commercial Code, if I'm not mistaken, is something that you should, Uniform Commercial Code is what it is. It covers legal implications of leases. The FASB, which is the Financial Accounting Standards Board in the US, has a statement 13, which details the proper methods on how you record transactions. And so they have a preset definition of various types of leases, and you try to stick to this as much as possible as you're making leasing decisions. Sarbanes-Oxley, which is an accounting reform in the US, which most organizations have already adopted, it is essentially an extra step that you need to do where you record your off-balance sheet transactions and other obligations and ensure that they're listed so as to avoid any malpractice. The IASB is the International Accounting Standards Board. It's a standard-setting body which is responsible for defining and setting financial reporting standards. So try to comply with, if at all this is a requirement, you should be aware and try to comply with the standards set by IASB. There may also be certain cases where your internal organization has specific or special accounting practice. It's imperative that you seek out and work with your finance/accounting to understand this. And as I stated already, this is particularly relatable to the US, but most other countries have various standards as well, so you should be aware of those. And I think that brings us to the last chapter. And, this is financing and leveraging strategies. And this is also goes in depth into the various financial concepts that you should do, that you should be aware of. And I'll try to be as high level as possible. Some of the key ones are you have to understand how the concept of cash flow and how it can affect the organization's operation. You should always, cash is king is something we've all heard, so it's pretty simple. Interest rates are also vital, as they directly influence the cost of capital, so be aware of interest rates and their impact. Payment terms are also a way of affecting or influencing costs. In the US, we had three almost commonly used payment terms. One was the net 30, which is just 30 days. And sometimes it's useful if you lengthen the payment terms in times of greater cash flow, where you need greater cash, you lengthen payment terms. Net 10th is when you have a 2% discount when you pay on the 10th. Net 10th is the 2% 10/net 30 is where the supplier has two options. You either pay on the 30th day or you pay on the 10th day and get a 2% discount. And depreciation is a tax shield that you should be aware of, and all of us will be aware of this as we file income taxes and whatnot. Represents the declining value of an asset as a cost. And So while trying to have financial and leveraging strategies, you have to understand that external market conditions can have a major impact. So some of the external market conditions that influence your strategies can be the stage of a product life cycle, whether what you're purchasing is in the early stage or is a mature. I think in fact that there are 5 stages of the product life cycle. One is the introduction phase. My apologies. I think the 5 stages are pre-commercialization, introduction, growth, maturity, and decline. So any product that you purchase will have to go through these 5 stages, and if you stay cognizant of which part of the life cycle what you're purchasing is in, it will help make appropriate decisions. A buyer-seller's market, the external market can be conducive from a buyer's perspective, which means there is greater cost savings, or if it's a seller's market, it becomes that much harder to return savings. Another aspect of it is a product risk over value matrix, where you try to understand the value of a particular product in proportion to its risk that it generates. Commodity markets also have a huge influence, especially if you're in manufacturing. Fluctuating commodities will make you vulnerable, may increase or rapidly decrease your material costs. So stay cognizant of that, and it can have a big impact on how you're vulnerable to your competition, or when you're trying to introduce new products. Fluctuating commodity market will have a big impact. And bond/currency markets are those when, especially you're purchasing in foreign currency, and you have to be aware of exchange rates, bond rates, and try to hedge as much as possible if you're forced to purchase in foreign currency. There are a few more considerations as you go through establishing your cost and finance strategies. You should be aware of all regulations that govern your category, local and international. You should be aware of tax laws in terms of what is your liability and the tax implications of certain product or service that you purchase from international. You understand import and export quotas. Largely in the recent years, this have been the value of this has diminished because of free trade agreements, but still useful to know. Supplier financing concepts is where you assist sometimes your supplier who's going through a tough financial condition or situation, because the cost of losing a supplier might outweigh the cost that you incur, the additional cost that you incur in assisting your supplier. So that you should definitely consider that where appropriate. And sometimes we did this in my organization, is where you actually invest in an external organization. You sort of own shares in a supplier, so you have a greater control over their management and operation. Centralized buying is a big concept which we all have. Centralized versus decentralized purchasing models exist across the world. We also have hybrid models. There are cooperative purchasing, where there are cooperative purchasing organizations, which is one entity which is a combination of multiple organizations pulling in their resources and gaining leverage. A consortium is also like a cooperative purchasing organization, but it's an external third party that represents a bunch of organizations. And it performs the same way, it transacts the same way as a cooperative purchasing entity. So with this, I think we are at the end of the session. I don't believe, typically I like to do a recap, but I think since we're already much past our preset time, you can, I know we've taken longer than anticipated, but if you have any questions, you can ask now, or you can always email me. I think my apologies, I haven't put my email on there. It's ram@bcubeglobal.com. So it's my first name, ram@bcube global.com. So with that, we conclude this CPSM review webinar on cost and finance. Are there any questions, or are there any comments anybody would like to make? Please raise your hand if you have a comment, and I can give you the opportunity to share your views. If you have any questions, please feel free to use the chat window to post your questions. But if you don't have any, it's perfectly understandable. With that, we come to the end of this webinar. So I'll hold on for another minute or two to see if there are any questions. If not,